Good afternoon, everyone. Today is Tuesday, December 30th, and this is our Chart the Markets live stream. I am Mark from Blunhouse Technical Analysis, and we are live today from our Blunhouse Telegram chat. And I'm glad to have a few people hanging around with us today. And if anyone else wants to join in our conversation, in our Twitter invite, you're going to see an invite to the Telegram group, which is at no cost. And you can jump in anytime and participate in these discussions or in any other ones we have throughout the day. And let's get right at it. I want to thank you for joining us. And what you're looking at today is the 1 hour Bitcoin chart. Now, I know we've talked about this chart quite a bit for a while, and let's just kind of go over where we are now and a little bit about where we've come from. Because, here we're rolling into the end of the year, and what we're going to want to be talking about is what could possibly be around the corner for us. And if we look at our Bitcoin chart, we were talking earlier, several weeks ago, after this big move down and price started to recover, let's not get too excited too quickly about what you see on the chart currently, because you have to deal with some resistance above, and you're going to have to change your mindset from this everything goes up all the time no matter what to now we're dealing with resistance in a way that we haven't had to in a while. And you can see what happens on that particular candle to the right of your screen. It finds the pink 500 MA and the green 20 MA, and those are first touches, and first touches have a higher probability of failing, right? And then that's kind of what happens, and then our indicator script kicks the sell signal from there. There's the 500 again, another test and fail, test and fail. This is the chop that we talk about that we really don't want to trade, but yet we're always waiting to see if we can be at the right place at the right time, and we can show you how to do that. But the point here was, you have to understand that all of a sudden longing into resistance becomes really uncomfortable, right? That's why we don't like to do it. And what happens ultimately? These tests and fails come back to the 20. So you're hoping on these failures that you get a bounce, and it's that bounce is the one that breaks one level, because we know if we break one level, we'll find the next. But unfortunately, that's not what happens. We break down. And now all of a sudden we were treating the 20 just like price treated that level at the 500. And the 20 becomes that resistance that we need to break through. Right? Yesterday's candle wicked the 50 and just ran away. Today's candle does show you a buy signal. And how do we sometimes find a little bit of an early entry? Just drop your time frames down a little bit, and you'll see the move on the 4 hour quite clearly, and then that's your confirmation candle. You don't gain a lot on this particular chart between the 4 hour and the daily. You gain a little bit, but not a ton. In other charts, you might gain a lot. But what's the resistance on the 4 hour? The 200 MA. So because everything is fractal, so as we're looking at that daily chart, understanding, okay, now we failed one level, and now it has become resistance. Right here we are with the 50. You can see where we are with the 20. We understand this level on a shorter time frame is the 200 MA. What's the relevance of that? It's our most basic bull bear indicator. So if we can break through in a meaningful way above the 200 MA, then I'm going to start entertaining taking that trade, and hopefully you're sneaking in an entry onto the daily. But if this fails, like it has all these other times, do we have an idea of where price might come back to? Absolutely. Because current price we know is drawn to past price. So if we fail this level, first thing we're going to want to do is come back to the T line or the 5 EMA. And then in here you have the point of control on the volume profile, which tells you that's where the highest concentration of volume has been. which is a natural draw for price. So if we do fail this level, you can see it was kind of extended. If you fail, you're going to come back to somewhere around here, T-line, POC, and then you've got the 20 and the 50 jammed in there as well. So there's a lot of reasons why it's going to want to come back there. But if this is the failed breakout and you don't get the support you hope for, where does price go? It comes back down and looks to take out the previous wave's lows, which then puts the lower value range on the volume profile in play. Because we have three choices for price, up, down, and sideways. What you're seeing is sideways. At some point, you're going to either break to the upside or break to the downside. That's what we're kind of waiting for. So we want to make sure that we don't get trapped, right? We want to make sure that we don't get trapped on the wrong side. If we fail here, roll back down, well, there's your previous wave's low level on the daily. And this is what? Light trading on the volume profile, which means that there's less to hold price up or down when it starts to move through it a second time. Right? So what do we have to do on the daily? We still have to break the 50. And then once we break the 50, what do you think the next level is going to be? It's going to be either this 500 here that you can see, and or that lower value range level. And these are just natural draws for price. And then you have this gap in here, because you understand that this is all gap, right? So if you can get up into there, price can move quite quickly. And those are trading opportunities. That's why we like them. And price, again, is just drawn to past price. So don't try and front run the chart. Understand what the opportunity is to the upside, what the risk is to the downside. Draws for past price. There's 1,000 MA. If this fails, we've broken one level. Do we find the next level? I remember months ago when we talked about price in this neighborhood in the 80s, and I remember saying, that's not today's problem. Well, it's more than today's problem now, right? So, because that's where we are. This gap does create opportunity to the upside. If you break one level, you find the next, yes. But if you break down and this downtrend continues, well then, it's a slippery slope. This is going to fake a lot of people out. They're going to go, okay, we've based out, now it's time to move higher, which may happen. But what do we do to try and understand what's going on a longer time frame? Well, let's look at the weekly chart. There's your sell signal up here, and you broke the 20, you broke one level, you found the next. You broke that level, you found the next. And we've been, like we said earlier, or late last week rather, that we've been playing around here for about, 4 or 5 weeks. This is the support you would expect from this average because it's the first time that you visited it since it broke out. And those first touches have a higher probability of bouncing or at least finding some support. Here's what I don't like about this weekly chart. Price can't seem to get ahead or above the 5 EMA or the T-line. All of these challenges, if it even breaks through the 5, they pull right back and they close below the 5 EMA, leaving all of this divergence open. What does that tell us? Well, this is what we're using to read trend. Right, so what we're seeing on the daily chart, all of this stuff, the testing and failing of, the 500, then the 20, and now the 50, is just this stuff here. That sideways stuff, just on a longer time frame. But what it's telling us on the weekly chart is that this downtrend is still open and in play and intact. And the fact that we haven't really tested the T line even is a little concerning. And here we have also the level of the upper value range on top of that, with this gap down beneath us, with this bench of past price that we've identified before. So if we fail this level, we fall into this gap, price will be drawn to these benches of past price where time and price will come together, time, price, and meet somewhere where it's been before. Right? And Joe, you can jump in. I know Joe's in the chat. If you want to jump in, Joe, please feel free. Because you can always add a lot of value. I know you can. And I'm more than happy to have you chat. So if you have anything you want to add, just jump in. So
Yeah,
again,
man,
that's
you nailed it, bro. I was going to say same thing around that 62 area, that there's a lot of trading history there.
mhm,
That would be an area where you would expect price to kind of migrate to if it was to have further downside. And then further below that, there's even wider open areas of trading value that really never took place. You can see it from the gap down way back in 22 all the way to the gap up in 24.
mhm,
There's a huge pocket there where price never really dealt there, man. It just kind of went either straight up or straight down,
yeah,
you know?
yeah. And sometimes, like in full disclosure, I've known Joe virtually for 6 years, 5 years now, something like that. And I think the first time I met Joe, we were doing a stream like this, and he said to me, "Is all I know about this stuff is that the green ones are good and the red ones are bad. But I'm really trying to learn." And now I think this guy's one of the better chartists and traders that I know. So it just goes to show you just have to concentrate, focus, and be professional, and this stuff works out. But I think you're right, Joe. And sometimes you and I might look at the chart a little differently now, but we end up in the same place, right? And that's actually kind of validation for all of us when that when that happens. So I don't see that as a bad thing. I see it as a good thing. And you're right. There's a lot of open areas here where price can come back to. If this is really a good chart because this weekly, because I want to show you how these gaps can get created. And just 1 second here. There we go. So how do these, I like to use the volume profile, you guys know that. But how do these gaps get created in the first place? Well, this is a weekly chart for a stock called Babcock Wilcox. And this gap here in the volume profile that you see to your right wasn't created here. It was really created back here. And as price just kind of capitulated straight down, and you can see you got a real clean sell signal, and then the chart just rolled over. Although they're like parabolic candles to the downside and price sunk, there's not a tremendous amount of substance in them, right, because of the parabolic part. So what happens is when you get to retest them to the upside, in this case, into the gap that was created, this volume gap, price can rocket through these areas with amazing velocity. And that's what you see here. Right? But that's how this gap was actually created back here, allowing you or creating an opportunity for you, the trader, to hit it with the hope that, hey, if I can break one level and find the next, awesome. And if I can break that level, get into this gap and find the next, and so on, that's great. And our script gave you a buy signal the week of May 27th. And you would have been anywhere from, 60 to 80 cents. You would have been in that week on that candle. Price is 610. So it's a good trade. And at no time did the chart tell us that we should exit the trade. Right? The divergence opens up. We can read that. We know that this is how we're reading trend. The candles are what we're using to read price, and this, what you're seeing here, is what we're using to read trend. So we overlay that ability to read price on top of the ability to read trend. It helps us stay in the trade and not get faked out, because we know, again, the direction of the trend is still in play. But I just wanted to kind of walk through how these gaps get created. It's not by the price that ripped through them most recently, it's by what was done in the past. And there's going to be a lot of charts out there like this that have been pulverized over time for whatever reason, and then just start to break out. Am I saying you want to hold this stuff forever? I don't know. We're not here to give financial advice. This is just reading price on a chart. But technically, you'll be able to come to those determinations on your own eventually. But that's how those things are created. So when you see these big moves up or down, they're going to create that type of opportunity up or down. And then this is a great way to monetize the chart. Now, when we look at some of the major markets, and I want to do that kind of quick, because we're very accustomed to things just going up. We are, right? And how do we identify in the market from our technicals when things might be softening? Right now, Joe remembers when we went back, years ago, when Bitcoin first fell off its, proverbial cliff, there were some clues. And they didn't necessarily show up right away in price, but they showed up in some of our other indicators. Right? The stochastic RSI is giving you an example here of where it's making kind of a lower high. The Fisher transform that you guys know I really like is also doing it. And if we were to look at our MACD, you would see the very same thing. What does that tell us?
I think the MACD was the sell for me. I remember you explaining that years ago in the live stream. You're like, you could see all the mounds of intense buying pressure, and then your MACD, you could see the clusters, right, just slowly, gradually fade and taper to the right. So you can see the buyers literally leaving the market, getting sucked out like a vacuum.
Yes, and it happens. It's kind of that, taking the foot off the gas, right? And those histograms they'll go lighter, and then they'll start to get shorter, and then they'll just, fade into red, right? And that's the foot coming off the gas. And that was an example of larger players exiting the market without anyone really being able to see it until it was too late. That's what it felt like anyways. But we saw it, right? And you're kind of starting to see the same thing here. Now, we could be totally wrong. We could get another candle tomorrow which could blast upwards and just break all this to glass, but that's fine. But we're just starting to do our jobs, right? We're noticing these lower highs. We're noticing the same phenomenon in some of your other indicators, and that's an example of a little bit of exhaustion. Is kind of what the takeaway is there. And if that exhaustion actually does materialize, well, what's the downside risk? The downside risk on the chart is this big gap. And this is a daily. Is it unruly for a price to come back to a daily 200? No. There's the point of control, and the next average that you can see that's been tagged twice is the 100 MA, right in line with the POC. So is it logical for a price to roll over and find that level and test it for support? Sure. The only difference is this time is that it's not the first touch for the 100. And if it fails it and gets into this gap, the 200 is in play at 20, let's just say 23 even. And 23 even on a weekly chart is just a hair above the 50. So, everything's fractal, time and price come together. That's probably where we're at. So is it unreasonable for price to come back to the 50 on a weekly chart? Of course not. It's also not inappropriate for it to come back to the 200. Like it did here. And this is what I think you can anticipate kind of coming into the new year. Because a lot of stocks, indexes, haven't seen these levels in a very, very long time. For the better part of a year, and in some cases more. And there's going to be a lot of drama when this takes place. Right? There's going to be, oh, the sky is falling, and so on and so forth. Well, these are simply appropriate levels for price to pull back to. And as this is unfolding, kind of keep that in the back of your mind. As dramatic as the event will feel, whether it's going to be a slow bleed or a quicker one, getting to these levels is going to be uncomfortable. But at the same time, understand that it's also completely appropriate, technically. And I think that's what freaks out people when we look at assets that are kind of dear to people's hearts, right? How do we not get hit by something we don't see coming? We drop your time frame a little bit. So this is the same NAS 100 chart where we started to show those lower highs. Well, should we be shocked about today's candle being red? Not really, because the 4-hour told us yesterday at 2 a.m. that we should be short right here. And if you were using this trend line, maybe you would see it strike through here and start to roll. You might even be tempted to take a short even sooner. But this is the safe entry. This is the market figuring itself out. There's your confirmation. So, yesterday at 2 a.m., you could have been short the market, and all of this stuff is just drama. And what do you know about what you see here? Let's blow this up a little bit more. See this divergence? It's still holding, even with the green candles that appeared up in here. It did nothing to change trend. And this is why it's important to be able to overlay your understanding of how to read price with an understanding of how to read the trend. Because half your friends would get faked out on those candles, where you're just like, hey man, that's just a green candle in a downtrend. That's all that is. Nothing to get stressed out about. Doesn't break trend. The divergence is still in play. So you know that it's still safe to be short, whether you entered here or whether you entered up here. Right? And that's the advantage that you have, or an edge as a trader, is having the ability to understand trend clearly while you overlay price. What does using these longer term averages do? Well, if we combine what we just talked about and then apply, I'm just going to go to Bitcoin again, and I'm going to try and find a shorter time frame. Okay, so people that are familiar with how we do things will know that we use a 1,000-day moving average and a 500-day moving average. That's pink is 500, and that amber is 1,000. We can argue all day long about whether you think it's appropriate or not, but it's something that we do. Why do we do it? Well, first off, it's incredibly effective on assets with a lot of price history, and we'll show that on oil in a second again. But on other assets, or any asset, what it does is it creates a target, right? So we have the ability to read price, we have the ability to read trend, but now we need targets. Because without targets, everything else is for naught, right? Like, where are we going to take profit? Well, there's our signal. All of this opens up, and you just continuously break one level to get to the next level. But what happens when you get to 1,000 days? You're done. It's reverse time. Or it's at least take a breath time. And why I say that is because we recognize that this trend is still open and intact. The trend upward. Here's our confirmation. We're still working under our bullish confirmation. These two candles here, what did they struggle with? The 50 MA and the 200 MA on the 1 hour. They went sideways, but you notice, just going sideways didn't mean they rolled over. The trend was up. The chart was bullish. They're just taking a little bit of a breath. That's a big thing to chunk through there, those two averages. But the trend was still up, so you were very confident that that was going to continue. And it found one level, it literally blew through it, and then you wick out here and start to roll over. Is this a complete capitulation? No, this could just be 2 or 3 red candles in a continuation of an uptrend. So you have a move up, a little sideways, back to the T line, and the 5 EMA. You move higher, the horse gets a little far away from the barn here and creates this kind of gappy price distance between the 5 EMA, and then comes back to that level to close it off. The fact that it's holding is bullish. Right? Even if it came back to test the T-line and held, that's still bullish. As long as that divergence holds like that to the upside, it's still bullish. What's the downside risk? Downside risk is you start to fail these levels, you come back to the 50 and or the 200 and the 20 all back in here, which would mean you fall into this gap with the attraction for price or the draw for price being below these levels, the POC and the lower value range, areas where price has been before. Right? But these averages, these longer term averages, help show you an additional level to have as a target. Because if you didn't have these, if you didn't have them running, basically you'd be looking at this. It feels different, right? It does, it feels different. It's like running around naked on Frosh Week, right? Like that's kind of the feeling. But all of a sudden, when you add a little context to the chart, it makes a little more sense. Isn't necessarily the first attempt. This one is, so this isn't. From all the way up here. So here we are with all of our averages kind of twisting together. Do we like that kind of stuff? Absolutely. What we want to avoid, though, is trading the chop. Right? These are reasonable trades up and down, sure, because here's your top end range. There's your lower end range. Meaningful trades. What you're hoping for is you actually get the breakout. This 1 hour chart gave you your signal Tuesday the 30th. That's today. What time? 2 a.m. And the chart's been completely open. Is it still a bullish chart? Yes. What does this mean? It means that you could have caught a nice early entry for the daily. And if the daily breaks, you can relax because you've created an early entry, a safe entry on a slightly shorter time frame, which will turn out to be hopefully a good trade. Fingers crossed, touch wood, a runner that rolls onto the daily. And onto the daily, I'm saying you want to eat up this gap. That's your opportunity. That's why we do this. We can talk about the buy and hold another day. Or you can talk about longer time frames of buying and holding. But just to give you an idea of, does our system work on all time frames and all assets? Well, yeah, here's a monthly Bitcoin chart, which gave you a buy signal in the week of April 1st, 2023. And has the chart created a sell signal since? Just this month. So, 18 months or so, maybe longer, you're up there with your feet on the desk. Almost 2 years. Like God. What's wrong with that? Now, does every one of these take off like this? No. Right? They might be like these types of moves. But every once in a while, this move started somewhere. It didn't start on the weekly. It didn't start on the daily. They always just keep backing it up. But this is why I like the 4-hour, because it can give me an early entry onto a daily chart. And if I get a runner, well, you don't know what can happen after that. Right? Go back to BW as an example. And how do you find these things? You can just scan for charts, right? Just use the tool within TradingView to do that. I do it all the time. And sometimes there are stocks or things that come back that I don't know what they are. But damn, the charts look good. They don't all work out, but if we apply the methodology that we use here all the time, we increase the probability of them doing just that, working out. Now, let's go. I think, Joe, you and I were talking about this chart a little bit earlier before we came on. And I'm just going to declutter this chart momentarily, with the exception of those two levels. So, let's go back in time. Right, let's go back to September 2023. And, here we are looking at that doji candle at the top of a meaningful leg higher, right after a considerable pullback. And where do we find support? Actually, I'm going to back it up even farther. Where do we find support? This is 2023, 2024. We find it at 1,000 days of price history. So David Steele Smith Elliott, the person who I learned a lot from, would talk about applying this average on commodities as an example, or stocks with a lot of history of price history. But when it came to commodities, what do we know about a lot of these commodities? That they trade in cycles, right? And because we believe in fractals, or he did, and I do, is that when you take a daily candle, you open that candle up, well, there's shorter candles in there, and the same applies to the monthly. You open it up, there's a weekly. You open that up, there's a daily. And when you see 1,000 MA on a daily, and then on a weekly, is it still 1,000 days on the weekly chart? No. Right? You have to factor in the additional amount of time, and you start ending up with decades of price history. And then you understand that, hey, within those decades or cycles, because we have an understanding roughly of how long a lot of these cycles are in commodities in particular. And then you can start to apply that logic to what you're seeing on the chart. So we showed how you were getting support at the 1,000 MA on the daily, just to give you an idea that it actually was respecting it almost to the penny in some cases. But here's our weekly. Now, you closed as high as, or traded as high as $95, closed at 90. So what do you think the narrative was? That the next phase is, got to be this next high. We're going to 100 for sure. Well, I'm only interested in what the chart says, not what the people say. And when I look at the chart and I see this doji at the top of a bull run that bounced off of 1,500 days, right? I'm like, okay, I had to take a little closer look here, right? I need to see what's going on. So what do? Well, we just start adding a little bit of context to our chart. So I can see that I'm too far away from the 20 MA. And I can also see that I'm pointing out points and flats indicate changes in direction, but I can see that the shortest MA that I use on this time frame is sitting at, $79. And well, that just makes me that makes me uncomfortable. When I throw the 50 down there, it's in the same neighborhood. But why is that important? Because those two together are just that much more of a stronger draw for price. All right, let's throw on the 100. Well, I can see if I come back to the T line that the 100 is there, and there's the 200. The bottom line is you're trading above all of your support. And at some point in time, you have to start to come back, or you will start to come back and check those. Right? So at the very least, you're going to come back to, in my mind at the time, 77, somewhere in that neighborhood where the 50 and the 20 come together. But what I was really focusing on at the first glance was the 200, right? That's our most, their most basic bull bear indicator, and it was sitting around just under $70. So as everyone else is going, you know what, we're going to 100, I look at this chart and I go, we're topped out. The nearest touch is like in the mid 70s, and then you've got your 200 on the weekly, which is, just under $70. And I'm like, I'm sorry, I think you come back to 70 before you see 100, because the chart looks exhausted. With the real target of being what? $61.66, which sounded, batshite crazy. I get it, all right? But you're only worried about that if you're concerned what people say. We're not. We're concerned about what price does, right? The fingerprints of money is what we really are interested in. And what did the chart do, right? Well, it started to break down. And it started to test those levels that we identified that it would want to. There it is coming back to the 50, but it doesn't hold it. It's starting to push these levels again. Do you notice anything here? This divergence is telling you what's happening. This is really simple stuff. Like, it's not that hard. I have tried to take all of the complicated things out of this so that anybody can do this. There's your signal short. All of the divergence opens up. And there goes price. And hey, what have we found? Well, we found 1,000 days that most people aren't even looking at. And you found the 200. These green candles did what? Tested the T-line, pulled back to close below. That's not bullish. All of this stuff is telling us you're still bearish. Now, we finally get, after basing along here for several weeks, you finally get a buy signal. But what do we know about this candle? When we look at this chart and we're looking at the upside as far as resistance goes, we see what? We see the 50 and we see the 20. Now we know that this is the first time price will test the 50 since breaking it. Same with the 20, really. So is that a high probability of failure? Yes, it is. Those first attempts have a much higher probability of failing. Did it produce a buy signal? Yes. But it doesn't mean the realities of technicals are erased as a result of producing a buy signal. There are greater rules in play, which one of them is first touches have a high probability of failing. We know that as traders, right? Boom. Bearish engulfing candle. What really sucks about this candle is it tested the 20 and it retreated all the way back to the 1,000 and the 200. Now here we go. Here's your buy signal coming off of this 1,000-day. Do you see how relevant this is? Now what happens? You break one level, you find the next, right? We have no idea what happens from one candle to the next, right? We don't know. It's just, your guess is as good as mine. But what we do know is that we have a lot of resistance above us, but yet we have all of this opening up. Right? All of this opening up. That's bullish. Notice something? and price comes back and retests all this stuff again and again and again. Lower highs. As long as you're trading below these levels, there's just no reason, and I'm going to go to the monthly, because we break one level, we find the next, and everything is fractal. Well, here we are. Right, here we are. Right back to the 500 MA on a monthly chart, sitting in mid-40s, 47. Do I feel good about that? It's not for me to feel good or bad about, right? Is all I know is that price has been here before and will likely find it again, and this is probably one of those times. And even though on the weekly chart we've had green candle weeks, does it change anything over the longer term about what we're looking at? No, I don't think so. And if we want to even stretch it out even farther, there's a quarterly chart. What does the quarterly want? The 3-month. It wants the 200, where it's been before. Time and price will come together because we live in a fractal world. And I think you can see time working its way into this area that we've talked about in price, meeting up in that area. We don't have any control over what we see on the chart. We just have to be honest with ourselves about what we're looking at. And that's, kind of what we're trying to do. But when the chart tells us things that we may not want to see or hear, who's going to win out? The chart or the narrative? This is a weekly chart for gold. Let's use the daily just for a moment. This is just noise, right, on this time frame. All these red candles. The trend has been up. And how do you take the noise out of those daily charts where they look a little irrational? Just extend your time frame. And that irrationality gets eaten up in one weekly candle. But when you look at the weekly chart, is this not one of the most bullish charts you've ever seen? Yeah. Right? Gets support exactly where you would want it to get support. And although there have been people saying, right, but we're not interested in that, we're just showing you the difference between what people say and what money does. People were saying back here, sell your Bitcoin, or sell your gold, buy Bitcoin, sell your gold, gold's done. Was it? No. You only say that if you're not reading this chart, or don't know how to read a chart at all. The chart is telling us, whether you like it or not, that this is still bullish. And even this weekly candle, albeit red, still trading above the 5 EMA on the weekly. That's bullish. We can identify the downside risk. That's easy. But let's be honest about what we're talking about. It's still a bullish chart. And it's not interested in what you think or what people think about Bitcoin or gold or what you think the world should be valued in or any of that stuff. It doesn't matter. This is silver. Bullish chart? Absolutely. Yesterday, according to everybody, the sky was falling. But I want to show you exactly what happened, technically. You wicked the T-line, and you moved higher. This is where you closed, obviously, but you held the T-line. The divergence between these two levels are still intact, telling you that the uptrend is still intact. And then there's today's candle. This is why we use this. And when you look at the weekly, what does the weekly chart tell us? Do we like this doji? Not necessarily. Right? We don't like dojis at the top of big, massive bull runs like this. And they come in all different types. But the positive thing is, You held the 5 EMA on the test and you pushed higher. Notice the two equal tops though, right? We do have to pay attention, right? So the downside risk, you come back here, maybe it's, just a simple test of the 5 or the T line, and then you bounce higher and take out the previous wave's low. If you don't hold, what happens? You just come down to the next level. And, if, let's say you're long and all this sudden price reverses on you, it doesn't mean you're wrong about anything. It just might mean that it's time to go short, because the job is to monetize the chart. And just think about it in terms of monetizing the chart. Don't think about it in the terms of my ego's crushed because price reversed in direction that I was originally in and now I'm all upset about it. Not important. Right? If we do look at our oil chart for 1 second, just on the daily, do you think this thing has an allergy to the 50? And this is the ice, right? There's a reason that my 50-day is ice blue, because it's the ice. And if you fall through the ice, it's kind of like drowning. And it's really, really, really hard to pull yourself up above the ice again. And what you're seeing an example of that here, right? A test of the 50 and a pullback. Today, it almost looked like it wanted to break through the 50 and now it's faded a little. But this is just an example of what resistance does and how hard it can be for price, and it doesn't matter what it is, to gain those levels, meaningfully trade above them, and then challenge the next level. Right? That takes time. When you see this weekly chart, you can tell, is this divergence still down? Yes. Are these maybe just green candles in a further downtrend? Right now they are. Tomorrow might be different, but that's what they are right now. And again, I think as you close out the year, spend some time looking at these weekly charts, because you're going to see a lot of this kind of stuff. I wanted to show you something on, we've shown you this chart before. It's called Xano. It's a crypto. And notice, put the volume profile back on. There we go. So here's your sell signal. Way up here, came on this big nasty candle. Notice how the divergence stayed open. Even though you had moments of price moving higher, they were just green candles in a downtrend, and you knew that because you could see that the trend down was still in play. Reverses a little bit here. There's a trade in here, right? And there's also an early entry on the 4-hour. But once you've broken all of your support and it becomes resistance, you have to expect this type of test and fail to happen, because nothing is going to be a V reversal all the time. Like it's a job to break through resistance. Look at that BW chart that we showed. It just got stepped on and then all of a sudden did start to break out. But what I want to show you here in this big move down and then this slight move higher on the daily, because we believe in fractals, right, and we're using these longer term charts to give us an idea of where we are in the scope of the longer trend. And what you're seeing here on that Xano chart, on this Xano chart that's a weekly, is, okay, here's our sell signal. Yeah, there was an earlier entry, but I mean, is this chart still bearish? Yes. This is starting to look to me like it could be a failed breakout. Right? Broke the 50, haven't tagged the 100 yet. Look at, you challenged the 50 weekly and failed, as well as the 5 EMA. This week's candle tests the 50 again, fails. Hasn't even tested the T line yet. This is starting to look like a failed breakout. And when that happens, you roll over and do what? Take out the previous wave's low. The weekly is still a bearish chart. And what you're doing on the weekly is failing the 50 and then snapping back to test it and failing it. Then this week's candle doesn't even want to have anything to do with it. Which tells me that this move probably is short-lived. Is all this is. This is the first, this is a retracement higher in a downtrend. Because the weekly is showing us that we're still nowhere near reversal. So now again, this is how you don't get hit by stuff you didn't see coming, is using these longer and shorter time frames. There's the early entry on the 4-hour that we talked about. That's a nice trade, right? There's nothing wrong with that. But just understand that as you're pushing up through all of this resistance, that, you know, it's not going to be clear sailing the whole way through. Use the multiple time frames to help you figure out, you know, whereabouts that you are in that trade cycle. Early entry, yes. Lots of resistance. You notice you're finding the problem here at the value range, the lower value range. Probably want to come back to these levels here. And what would those fib levels be? Because we use fibs, fractals, and filters. Let's just do this real quick. There's 618 right in here, in and around where the 50 is, and here is 50% right in around where the 100 MA show up. So are these two levels a draw for price, whether it be the 100 MA or the 50 MA? Absolutely. Is 50% in 618 reasonable draws for price? Absolutely. Telling us what? There's probably more downside to come. And we have these volume gaps here on the right, which are opportunity for us. See this chattery level in here? That's the shelf. Break that shelf, though, to the downside, and all of a sudden price starts to open up. And the only thing that would change this is a big influx of money in that continues over a long enough duration to change the trend. But right now, this divergence here between the T-line and the 5 EMA are opened up, and it looks like they want to move down. This is Monero. Nice march up, but you can see the volatility here. But where does it get support? From the 50. Is it running a little hot? Yep. Does price like to get too far away from the 20? Nope. So I would expect price to want to come back to the 20 at some point. What has to happen for that some point to become a reality? You break down from the 5 EMA and the T-line, and then the next level down becomes the 20. Don't hold the 20. Find the next level down. Notice all of this gray. This gray is light trading, so things can happen in these areas quite quickly. Where's the most concentrated volume? Way down here at 141, 143. But that's what happens when you push price higher. Just remember that on the reversal, you'll come back and check those levels. And the only reason we tell you this is just to get ready to monetize the chart to the downside. But it's just another example of a weekly chart with a lot of targets to the downside that are completely reasonable technically. So, you know, that's kind of where we're at. Aster, I don't even want to spend too much time on it. It just can't get out of its own way. I know there's a lot of people that thought this was going to be the next best thing, and maybe it will be. They'll probably wait till they push it down till they can't stand the pain anymore, and then they'll just shoot it right back up. But this thing has been, on the daily, you challenged the 50 up here and failed, and then the thing just rolled over. And if you were short up here, whether it be at our confirmation or at this funky top, the chart gave you no reason to close your short. Even on these green daily candles, they didn't break trend. They're just green candles in a downtrend. All this divergence is telling you price is moving down. And this little failed breakout will probably come back and take out these lows. You know, I understand it's not always good news. Right? Let's look at Master. This is probably getting a little bit of a bump today. But if we go back, let's go to the weekly just to tighten the chart up again. You know, up here, we said look for price to come back down here. Well, here we are. Break one level, find the next. Break one level, find the next. Here's the 200 MA. And we're showing you that that's the extension of this level. Here we are. Why is it attracted to this level? Because it's the bench of past price that it's going to sit on in here when all else fails. That's kind of how it goes. And look at this, like we showed on the weekly, or monthly rather, and it's even cleaner. So here's the 50. We're looking for the 50 monthly, the 200 weekly, and 1,000 days on the daily. We live in a fractal world. All of this is fractal. I know it sounds like up here nobody wanted to hear all this. This was an impossibility. But it's not an impossibility. There's no reason to long this chart. Well, you break the ice here. Test, fail, another bearish engulfing candle. So I think you're going to see more charts do what this did over this year, because they're just too far away from all of these levels that are technically appropriate. You know, we're not here to argue on what we think this thing is worth or how it's run or anything like that. This is just a chart. But it did everything that we anticipated it would do. Just like oil did. Just like Bitcoin has done. And there's nothing here that's magical. Right? There's nothing here that's magical. This is all very easy to pick up. It's just repetition, treating it like a job, like a profession, and not a game. And being serious about what we're doing and mitigating your risk. This kind of stuff can change your life, right? It can literally make your life better. You don't have to get, like a lot of people do this because they don't want to get that part-time job where, you know, they're hoping to make, you know, $100 a day kind of thing to supplement their income. Maybe they're single parents. Can you make $100 a day doing this? Yeah. Absolutely. Just start somewhere, right? Get the training that you need. And just to show you how all of this works on stocks, and doesn't matter what you want to trade, this is a daily chart of Walmart. Right? And it's obviously had a nice move higher. Can't deny that. It's been a bullish chart. But what are we starting to see up here? It's a little bit overextended. See this, you know, you're watching this big move extend itself from the 20 as you're watching price do this and all of these averages spread out. You're actually preparing yourself for when it retests that 20 again. If you weren't already long, this is your next opportunity to monetize the chart. And what's interesting here is this is your confirmation. This is the insurance you pay to make sure you're on the right side of the trade. And you can see this divergence open up. Now, you've had 4 days of green trading. Has it changed the trend on Walmart? No. The trend is still down because the divergence is in place. You've filled one level. You're looking for the next level. This is a failed breakout, potentially. We roll over, take out the previous wave's low, and from there, that's going to put the 50 in play. And the level of the upper value range. See this gap? You fall into this gap, as you come back and take out, you're going to end up down here. The only thing that's going to change that is a big influx of money. And what does the 4 hour tell us? Right? Because we want to look inside this daily candle to see if we can get another interpretation of what might be going on. Well, we do. Like you can see at the top there, there's your signal. Here's how we sneak entries onto the daily. And this one did. Got us in early last Thursday. Short. Breaking one level. And what happens when you break one level? Find the next level. What do we know now that we're here? This divergence is still down. This hasn't broken. Yeah, you have green candles, but there's so far they're just green candles in a downtrend that can't do what? Break the 50. Well, what's the 50? The 50 is the ice. We've fallen below the ice. What are we looking for on the 4 hour? Probably the next level down. Right. And this gap is going to help us get there. I guess we'll have to wait a few days to find out, but that's why we do all this stuff live, and that it's on our YouTube site, so you can go back and check the receipts. Right? We only have 3 options: up, down, and sideways, and it's just building a case which has the highest probability of being the correct outcome. This is bearish, though. These are simply green candles right now in a downtrend that have failed the 50. With a gap. And so this is a premium. Think of this as paying a premium. They don't call this an upper and lower value range for nothing. It's almost like a VWAP, right? Where the VWAP is telling you that's the volume weighted average price, and that's an acceptable area to pay. You don't want to pay above the VWAP though, do you? No. Because you'd be paying a premium. This is going to be an interesting chart to watch, in my opinion, over the next 12 months. And here's why. So here's just another example of what we were talking about, and why I want you to start looking towards the end of the year now at these weekly charts, because they're going to show you what the downside risk is. Quite clearly what the downside risk is. And then you have to start to ask yourself, well, whatever drove price to do this to the upside, is there that much more of it in the tank? Don't know. At some point this becomes sketchy. This next touch of the 50-day moving average on Walmart will not be the first. Okay, so keep that in the back of your mind. This is going to be an interesting chart. And I'm not sure yet if, just like we try and sneak an entry onto the daily chart by using the 4 hour, well, you can look at the monthly and use the daily to sneak an entry on it. I'm not sure that we're quite there yet, but we're getting closer. Be careful with this. And you're going to see lots of charts like this. Weeklies that have this tremendous downside. This is Microsoft. Does this look like a top to anyone else in the room? Like, that's kind of strange looking, right? Like, there's weird stuff everywhere, but that's obviously the toppy area. And what happened up here? We just simply kissed the upper value range and came right back to the 50, broke the 50, broke the 100 MA, found the 200 MA, because you've broken one level and found the next. And you can quite clearly see, the 200 giving you support, and your upside resistance is going to be the 50. Do we have, for those of you that are into these kind of things, Do you think it's more likely that the 50 crosses down through the 200 or the 200 crosses up through the 50? Because that's either going to be a death cross or a golden cross. And this is kind of starting to get a little wedgy, and it'll be interesting to see how price reacts. Because you haven't hit the 50 yet here, right? So you've broken it. This is going to be your first major touch. Same with the 100 here. So these are first touches, and first touches have higher probabilities of failure. And actually, before I come back to this, what is this level? 497. So it's 497 on the weekly, literally just beneath the 20. That would be the first touch of the 50. First touches typically fail. This would be the first touch of the 20. First touches typically fail if it was to move to the upside. Right now it's still a bearish chart though. But look where the 200 is, right in the middle of this gap. And it's not unreasonable for price to find the 200 weekly. And there's charts, all kinds of them, that look exactly like this. Apple, weekly chart. Look where the 200 is. Way down here at 192. Still a bullish chart? Yeah. Trading a little bit ahead of its skis. Maybe the horse is a little far away from the barn and it'll want to come back to the 20. Yeah, it looks like it. At some point it is. Is it trading in all that premium gray area above the upper value range? Yeah. So why is it unreasonable to think these things won't come back and retest? And that's, you're either going to look at that, depending on how you're positioned, as opportunity or risk. For those that are super locked into their longs, that's going to be a lot of risk. For those with cash on hand or who are well hedged, it's going to be a lot of opportunity. It's just a matter of when does that when do you actually hit it, right? When do you actually try and take advantage of what you think that opportunity is? The chart will tell us, right? The chart will tell us. Apple's daily, right back to the 50. Here you broke it. This is your first touch. This is where you would expect to get some support or a bounce. We know that. We've showed this on all kinds of charts today. But what's important to take away from this chart? This downtrend is still intact. So this is a very, very, very critical time when you have an asset that's getting support, that's first touch from the 50 under a sell signal with divergence, you know, between these two levels that's still intact, telling you the trend is as well. If you don't hold, so finally this gives up and just doesn't have enough in it to bounce, and it gives up the 50, what's it going to look for? It's going to look for the 100. And it sits right at this shelf. So that means price falls into this gap and then comes back and sits on the shelf. And if it can't hold the shelf, does it fall into the gap? This is like, you know, elf on a shelf, right? If it can't hold the shelf, it falls in here. It's right back to the 200 daily. And that's the level for the upper value range, which means this is a bit of a premium. 232. 232 on the weekly is the 50. So I feel relatively confident that price will come back and test those areas. I'm not saying it's going to stay there or anything like that, but this is really bullish and still is, but it's running a little hot. At the very minimum, you're going to come back and test the 20. And if any of this stuff doesn't make any sense, just say so. Now, I want to show you the chart for Target because it's complete contrast of the Walmart chart. Right? And we can talk all day long about why that is, but if you don't think everything is technical to some degree, you're probably missing out. This goes back to, what, 22? 21, late 21. And everyone's like, wow, that's a double top on target on the weekly. Well, it's 2 equal points in price. The double top doesn't really get claimed until it takes out that center channel there. But what happens? So your signal shows up at 250. So you could have been short from in and around there, right? The little bit to the left is what you pay for insurance to make sure you're on the right side of the trade. Did we fan out all of those averages because price went parabolic? Yep. And then you have to come back and test them? Yep. Do you break one level and find the next level? Do you go through the process of testing and failing major moving averages? Can you use the divergence that the T-line and the 5 EMA provide to help guide you through the trade to make sure you're on the right side? Yeah. This in here, this is the chop, right? That's all chop. We're not super interested in the chop. We like the breakouts and the breakdowns. But this is a very different looking chart than what Walmart's is. Nobody thinks when you're up here that this level will be tagged again. Nobody. Most don't even recognize its existence. And here you are. Just because it looks unreasonable, or you're afraid that, people will think you're crazy. I get it. But the chart doesn't lie, right? They don't all break down like this. But you just know that if you break one level, you find the next. And you know that your downtrend is confirmed. Boom, snap back, hit the 50, fail. Why did you fail the 100 here? Because you already tested it. Boom, right down to the 200. The next thing you test is the 50 and you fail. And the process of testing and failing is pretty consistent. It doesn't matter what you look at. Should I be concerned about this first touch failure of the 50-day moving average? Yeah. Yes. Because you trust your chart. Would you not be maybe, personally, that's a short opportunity. First touch. We'll see. But this is a very different looking chart from Walmart's chart, even though they're in the same category. Literally the inverse chart. Let's look at Tesla. As erratic as it is it still a bullish chart? Yes. Right? You have come back, you hit the 50, you bounce. Or 20, sorry, you bounce. And you did what? You took out the previous wave's high. And now that you've done that, you take a little bit of a pause, which you've done. You've come back to the T-line. And the question is this just like a tag up and then you move on again? Or do you break down and you test the 20? Again, we have 3 choices, up, down, and sideways. And we have a handful of rules that we use continuously to help guide us through the trade. Cleveland Cliffs, which is a steel maker. Again, here we are. So you were trading all above all your major moving averages, and then you start to come back and retest them. You know what's interesting here? When do the wheels fall off for Cleveland Cliffs? When you break 1,000 days of price history. You break that, and it's one nightmaric process to regain your footing. And when you test and fail, you remember that you're continuously taking out lows, right? And that's a slippery slope. But what do you see here? First touch of the 1,000-day moving average does what? Fails. know what to say. Right? But there's a reason why we use it. These averages, longer term, help us frame in a price, trading area, and trading range. That's exactly what this has done. Is it irrational to long off the lower value range when it seems appropriate? No, not at all. Is it irrational to expect some resistance at 1,000 days of price history when it's the first time you've seen it since you broke it a year before? No, it's not. But if you weren't looking at it, you wouldn't know it was there. And that would just appear like, just this hanging parabolic candle that gets retraced. It's good to know what you're hitting your head on. Because if you back this chart up, we still have, here's the 500. There's the upper value range. These longer term averages help us frame in a trading range. And when you can break the highs and lows of those ranges, you might be onto a larger move. But in the meantime, you're basically shooting fish in a barrel within a trading range. This stuff, I'm going to show you, where are we here? This is Canopy Growth. Not to beat up on Canopy Growth, but I've tried to communicate that these things are somehow going to break your heart time and time again, and here they are, right? Like, they get a heartbeat every once in a while. People get all excited. Maybe it's usually news related, and if that's how you're trading, fine. But I mean, these things will just come back and do the same thing they've always done, at least for now. Like, there's just no sign of anything really changing at all here. And as a matter of fact, on the weekly, you're now getting another sell signal. So is this your failed breakout that comes back to do what? Take out the previous wave's low. If you're a fundamental trader, you got to ask yourself, what's the path to profitability is here? And I think you'd find that there isn't one, right? And I think that is represented maybe in the technicals. At one time, was it something fun to trade? Absolutely. Wild to short it, right? But this is not the best use of your time right now, in my opinion. There's Google's daily. We're going to remember these charts at some point this year, going, wow, that seemed impossible at the time. However, history may prove us a little different. Here's the weekly. And the reason I'm showing you these is because I just want you to get a visual understanding of how far away these levels are that we come back and test time and time again, just like we've showed all day. This is all gray, which means it's very light volume. This is just, here's your weekly buy signal, the week of the 19th of May. And, this is the market figuring out what it wants to do. There's your confirmation. And you had no reason to look back and exit that trade. Our system tells you the trend is intact, and you have the ability to read price, and you understand what price means in relation to these levels. These are just 3 red candles in an uptrend, 2 red candles in an uptrend, 2 red candles in an uptrend. The fact that they test the T-line and continue to push higher is bullish. And this chart still is bullish. But eventually it will come back and test this T-line again and not hold, and then test the 20. And then you're in a first touch scenario where you hope that it gets a pause or bounces higher. If it does that, it's going to do what? It's going to take out the previous wave's high. If it fails, well, then you come back to the 50. But I think this is what you have to look for this year. Are stocks coming back on these longer time frames once you see how extended they are? Do they continue to overextend themselves? Or do they do the right thing? Does the market do the right thing and let a little air out? We don't know. We can only trade what's in front of us, right? That's it. That's all we can do. That's why this ability to retrend is so important in relation to price, in relation to targets. Four-hour Google chart. This is kind of interesting. Maybe these things do fade a little bit. This is bullish, but it doesn't like the, it doesn't want to push past the point of control or that upper value range. If it fails and falls into this gap, well, that's how the wheels start to come off. Or at least it will feel like wheels are coming off. They're literally just coming back to acceptable points on the chart, though. But that's why this year is going to be so interesting, because there's so many charts that are like this, and they're everywhere. Nvidia. Does this look like sideways trading to you guys? Yeah. Picked up here by the point of control is actually showing you that's exactly what this is. So if we're trending sideways, we're looking for the next move to be either significantly up or significantly down. And we just have to let the chart guide us. Here you get a weekly buy signal. I don't know if it sticks or not, but does price want to move up and challenge these highs? Potentially. But the chart, just follow the chart, right? It's not a matter of what we think, it's just a matter of what the chart's telling us to do. And sometimes it's going to be more difficult to figure out than other times. Now, I have something that I love to hate here. This is Remax. The weekly chart of Remax. Like, this is what it feels like to kind of go through this. This is the 50. See, notice how the 50 seems to always be the one that gives you the most consistent tests and fails in these pullbacks or capitulations or whatever you want to call it. So here's a weekly chart of Remax. Is this a bit of a bottoming process down here? It looks like it. The question just becomes, does it have the ability to bounce and move higher, or does it just die? Like, it's one of those, it's becoming one of those stocks where you just want to take it out behind the barn and shoot it. Like, there's the monthly. Maybe it becomes a takeover to, I don't know. But right now, nobody wants it. And nobody's wanted it for a while. Charts don't lie. People do. People tell us what they think with their money. What do they think of this based on that? Money talks, right? It speaks a language. This is a language. Mathematics is a language. Everything we do with our technicals is based on mathematics. Thus, it's a language. It's the language of the market. Let's look at the Qs, which is kind of your NASDAQ. Is this not maybe? It's a big, massive run. China trending sideways again. Are we trending sideways, kind of gassing up to make another move higher, or is maybe this the start of a broader sell-off? Is it inappropriate to come back to the 200 on a daily? Of course not. 555. What's 555 on the weekly? Roughly the 50. So, you know, at some point we're going to come back and test these levels. And I think that's what we have to look for, guys, moving forward into the new year, is these longer term charts that have been on fire, that have just pushed out because of they've gone that kind of parabolic route. Again, use Google as an example, like where they've just gone parabolic and all of this stuff gets fanned out. Well, eventually, when you let the air out, Price tumbles to these levels and checks them off one at a time. So don't fear the Reaper, but know that you have to monetize the chart, and there will probably be some opportunities to the downside as we come back and check these. I'm not saying that they're going to stay down there. You know, this could just be a matter of Google's weekly coming back, finding the 20, bouncing, and then taking out the high and moving on, right? We don't care. I'm indifferent to price. I don't care what it does. It goes up, down, doesn't matter to me, because the job is to monetize the chart, not to fall in love with the asset. Okay? So this will probably wrap it up, I guess, for this year, because I don't think we're going to want to come back on Thursday. But we'll certainly come back the first Tuesday that we can in the new year. And I just want to take a second and thank all of you for watching these streams. I know a lot of you watch them on YouTube after the fact, and that's great. But all the people that come into my Telegram, I really appreciate all of you. And it wouldn't be such a fun place that we learned so much if it wasn't for you guys. So I want to thank you for that, and thank everyone for watching these streams. I really appreciate it. And